Hello everyone. In this video, I'll be explaining the key concept from Chapter 10, the Foreign Exchange Market, based on Hill's International Business Textbook. Let's explore what the foreign exchange market is, why it's matter, and how companies manage the risks that come with currency movement. I will start to explain with the opening case. And then the opening case, you're talking about Thai baht compared to US dollar. Baht exchange rate volatility. Since 2005, the Thai baht has fluctuated between Thai baht 30 and 36 per US dollar, with a strengthening to Thai baht 29.81 in 2020. There's a challenge faced by a lot of Thai exporters, such as exchange rate fluctuation can reduce revenue for Thai exporters, even if the quantity and the type of goods remain the same. There's some recommendation given by the Bank of Thailand suggest that using hedge strategy, such as purchasing forward contract to protect against exchange rate risks. However, some of the small and medium exporters, they didn't use that recommendation, and as a result, a significant portion of small and medium exporter, around 72% or maybe 59%, did not hedge, and leaving them vulnerable to exchange rate volatility. They also face some geopolitical risks and sanctions, especially for Thailand itself. The exchange rate movement can be influenced by geopolitical factors such as the risks of sanction from US due to currency manipulation concern, making hedging even more critical. From this case, we learned that it is important that for countries to apply or for companies to apply specific hedging strategies to protect their own value of money. The foreign exchange market, or forex, is where one currency is converted into another. For example, when Thai exporters sell goods to United States, they receive US dollar and then use the forex market to convert them into Thai baht. This market is crucial because it provides insurance against foreign exchange risks, which is the risk that unpredictable exchange rate can change, affect profit or also cost. As you can see from the slide, you can see that every different countries, they have their own currency, such as Argentina, they have peso, Australia, they're using Australian dollar, Bahamas, they're using Bahamas dollar, Brazil, they're using real, Bulgaria using lev, and so on. International companies, they use forex market for several reasons. The first, to convert payment received from export. Second, to pay for import in a foreign currency. Third, to invest short-term in foreign money market. And the fourth, sometimes to speculate, trying to get profit from short-term currency movement. One important concept here is hedging. Hedging means protecting your business from potential losses due to exchange rate fluctuation. Companies can use tools such as forward contract or currency swap to lock in exchange rate today for future transactions. For example, the Bank of Thailand recommends exporter to hedge because of baht and US dollar rate has been volatile for years. In this slide, I would like to show you there are two types of hedging strategy. The first one called as spot exchange rate. This is the rate of which a foreign exchange dealer convert one currency into another currency on a particular day. So in a spot exchange rate, it depends. If you want to pay today, for example, today is 28th of October, then it will depend on the course or maybe the currency on the 28th of October, and then you have to just transfer based on that particular day. The second type of hedging strategy is a forward exchange rate. It's the rate used for hedging in the forward market. These rates for currency will exchange the typical quoted for 30, 90 or 180 days into the future. Just for example, like if you want to having transaction with different countries or different companies from different countries, you will have some agreement first that I will use today currency, convert currency for next 30 days payment or next 90 days payment or next 180 payments. So in the next 180 days that you need to pay, it based on the particular days. It depends on what you agree, in which currency dates that you agree to use. The third type of hedging strategy is currency swap. The currency swap is the simultaneous purchase and sale of a given amount of foreign exchange for two different value states, and the swap are transacted between international business and their banks, between banks, and also between government when it's desirable to move out one currency into another for a limited period without incurring foreign exchange rate risks. This is some figures showing there are two different companies came from different countries. For example, US countries, United States, and the other countries is Brazil, and then they try to exchange 1,000 million US dollar with 160 million real between two countries. And then the first thing that they do, the company A from US, they try to invest their money to a local bank and they will receive 4% interest, while also the money that received by the Brazil company, they will invest the money to the local bank in Brazil and they will receive 5% interest. They will agree like pay back the next 2 years, and then company B, which is Brazil, will pay of 100 US dollar with 4% interest back to USA, and the same with that company A that came from USA pay back 160 million Brazilian real with 5% interest. I suggest you to see more explanation about swap currency exchange through the video that has been uploaded in the course site. The foreign exchange market is a global network of banks, brokers, and foreign exchange dealers connected by electronic communication system. And the most important trading centers are located in London, New York, Tokyo, and also Singapore. The market is always open somewhere in the world. It never sleeps. They are connected because of high-speed computer linkage between trading center. There is no significant difference between exchange rate in the differing trading center. And then if the exchange rate quoted in different market were not essentially the same, there will be an opportunity for arbitrage. The arbitrage is the process of buying the currency low and selling it with a high price. Most transactions involve dollar on one side, and then dollar itself has been mentioned as a vehicle currency along the euros, Japanese yen, and also British pound because their value is strong and more unstable. So what makes exchange rate change? They are mainly determined by the supply and demand for different currency. There are three key factors will affect them. The first one is inflation rates. The countries with high inflation, they tend to see their currency weaken. And then the second one is the interest rates. The higher interest rates often attract investors and also strengthen a currency. And the third one is the market psychology. For instance, when traders all accept currency to rise, expect the currency to rise, they buy more of it, creating what called as the bandwagon effect. The bandwagon effect occurs when expectation on the part of traders turns into self-fulfilling prophecies. Traders can join the bandwagon and more exchange rate based on group expectation. So in Indonesia, or maybe in different terms, we can call it as FOMO. It's like fear of moving, fear of missing out. So you are afraid that if your friend also doing tradings and they sell their dollar, for example, and then you don't do the same, you will feel like I'm gonna lose something. I'm afraid that I'm going to lose something, so you will follow. Yeah, it's called as the bandwagon effect. There are two schools of thought about predicting exchange rate. The first one is the efficient market school that believes the currency forward rate already reflects all available information, so paying for forecasting is pointless. While the second view is inefficient market school. They believe forecasting can help, but in reality, even professional forecast often fails to beat the market. So this is more talking about the forecasting service importance for companies, and then you can just have different point of view, yeah, based on efficient and efficient market school and inefficient market school. How are exchange rates predicted? There are two schools of thought on forecasting. The first one is by using fundamental analysis, draws upon economics factors like interest rates, monetary policy, inflation rates, or balance of payments information to predict exchange rate. So in the fundamental analysis here, I would like to say that example from the previous slide, if the interest rate is high, usually investors will be interested to put their money in many form of investment, such as in stock, money market, or maybe they want to put in obligation and so on. And then if a lot of requests or investment on that part, usually your currency will be higher. And the second type is technical analysis. This is in the form of chart trends with the assumption that past trends and waves are reasonable predictor of future trends and waves. Just for example, like if you believes based on the previous year, during Natalan or Christmas, a lot of people spend their money and doing consumption, it will be strengthened your your currency, because people spend their money, they do shopping, and it has bring a lot of dynamics in economics. Not all currency are equally flexible. There are three types of convertible currency. The first one is really convertible currency, like US dollar or euro, can be easily exchanged without restriction from the government. Some countries have limited or non-convertible currency, restricting exchange to prevent capital flight when investors move their money out of the country quickly. In such cases, companies might resort counter trade, where goods and services are exchanged directly instead of using money. There are also another type of convertible. It is externally convertible, when the non-residents can convert their holdings or domestic currency into foreign currency, but when the ability of the residents of convert currency is limited in some way by the government. To sum up, the foreign exchange market is more than just a place to trade currency. It is a system that supports global business stability. By understanding how exchange rate works and how to hedge risks, companies can make smarter international decisions and protect their profit. Thank you for watching.